Welcome to the Coin Bureau Weekly News Roundup. Here are the top stories in crypto this week. Crypto market rally. Bitcoin dominance drops and altcoins take off after Ripple secures a partial victory against the SEC. Why did the crypto market crash less than a day later? Important Ethereum updates. ETH pushes past 2K for the first time in months, Celo plans to become a Layer 2, and Aave votes to launch its Go stablecoin. How will this affect ETH? BNB's red flag. Binance lays off thousands of employees shortly after its exchange token announces an upgrade that allows for its blockchain to be frozen. When will the Binance FUD finally stop? China's economy chokes. The world's second largest economy stumbles, leading to speculation that its central bank will have no choice but to print. What does it mean for the crypto market? And a closer look at last week's top performing cryptos and where they could be headed next. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy. None of what follows is financial advice, and here is the news. Last week, the crypto market experienced an explosive rally. This was in large part due to Ripple's partial victory over the SEC. Now, we say partial because the judge ruled that Ripple's XRP sales to institutions were unregistered securities offerings, meaning the company could still be on the hook for these sales. The other part of the partial is what caused the pump, though, and that's the ruling that XRP itself is not a security. Moreover, sales of XRP on exchanges and other secondary sales were also ruled as not being securities offerings. Now, we'll be doing a deep dive into this historic ruling later this week, so stay tuned. The news, of course, caused XRP to explode, and other altcoins the SEC had labelled as securities in other cases followed suit. This was somewhat surprising considering that XRP is significantly different from most altcoins, and you'll know this if you watched our video on the SEC's reasoning about these alts. In any case, the consequence of this massive altcoin rally was an equally massive drawdown in Bitcoin dominance. As you can see, Bitcoin dominance has crashed, and BTC currently makes up around 50% of crypto's market cap. This is a key level that may or may not hold, but a bounce seems likely. If you're subscribed to our weekly newsletter, you'll know this is because there isn't a marginal buyer around to keep pumping everyone's altcoin bags. In case you haven't noticed, interest in crypto is still relatively low, and this means there aren't retail investors to turn this altcoin pump into an alt season. Of course, this could change if the crypto industry continues to win against the SEC and its ilk, but for now, it seems like most of crypto's victories have centered around Bitcoin. Besides the spot Bitcoin ETF application by BlackRock, an actual spot Bitcoin ETF is expected to list in Europe later this month. Regardless, what everyone is wondering is why the crypto rally was cut short. Now, in theory, it was because of the FUD around Binance laying off lots of employees. In practice, however, this FUD was probably priced in. Binance had reportedly been planning these layoffs since May. More on that later. Another possible cause could have been the BTC sales by the US government. Some of you may have seen the headlines that it had moved 10,000 BTC, presumably to sell. The last time this happened was back in March, and crypto crashed shortly afterwards. Consider that 10,000 BTC had been sent to Coinbase in March. This is another topic that we'll be tackling later this week, so be sure to keep your eyes peeled for that as well. Now, the good news is that the crypto market retained most of its gains despite the subsequent flash crash. The bad news is that there's still no shortage of catalysts that could take it lower. BTC's daily chart suggests we could be in for some short-term pain, but again, we'll come back to that later. For now, though, let's turn our focus to Ethereum. ETH managed to push past 2K last week, and if you're subscribed to our weekly newsletter, you'll know this could be a sign that the crypto market is headed higher in the short term. Be sure to sign up so you don't miss our forward guidance, link in description. Anyways, it's easy to understand why ETH had such an impressive pump when you realize that the Ripple victory wasn't the only positive catalyst for its price. For starters, Ethereum surpassed a milestone of 20% of ETH's supply staked, further increasing the security of its already secure blockchain. Ethereum builder Consensus also revealed its zero-knowledge EVM Layer 2 scaling solution dubbed Linea. Now, before you get too excited, the company said that it has no plans to issue a token, but, well, I suppose that's what every Layer 2 says when they start. A token always seems to come eventually. Speaking of Layer 2s, though, Starknet, another zero-knowledge solution, released an upgrade that increased its transaction speed to 90 TPS. Now, this doesn't sound like much until you remember that Ethereum's upcoming dank sharding upgrade will further supercharge Layer 2s. More about that in the description. And another important Layer 2 update came from a Layer 1. Celo has floated a proposal that would see its standalone EVM-based blockchain become a Layer 2 on Ethereum in what appears to be a first for the crypto industry. This could foreshadow other EVM-compatible chains following suit. Come to think of it, it's possible that the real showdown during the next bull market won't be between Layer 1s, but Layer 2s. This likely depends on whether interest rates remain high or start going lower. Low interest rates mean more speculation, which could mean more inflows into ETH competitors, not Layer 2s. Anyhow, another significant Ethereum development was the deployment of Aave's Go stablecoin. For context, Aave is the largest borrowing and lending protocol on Ethereum, and Go is a decentralized stablecoin. Aave has been working on it for months, and it was finally released after a community vote. If you've been keeping up with the channel, you'll know that we're huge supporters of truly decentralized stablecoins. That's because if crypto continues to rely on centralized stablecoins, or worse, CBDCs, then it could become a part of the financial system it's actively trying to replace. Go's market cap is currently in the millions, which isn't much, but it's a good start considering crypto market conditions. For reference, the demand for decentralized stablecoins like DAI is closely correlated to ETH's price. If ETH continues to pump, expect Go, DAI, and others to grow. Now, the only really bearish headline about ETH wasn't really ETH-related, and that's Coinbase being required to restrict ETH staking in 4 US states. If you watched our video about Coinbase's lawsuit, you'll know this could be bad. Winding down ETH staking could be an admission that it constitutes a securities offering. For what it's worth, Ripple's partial victory over the SEC likely means more profits for Coinbase, especially since the exchange relisted XRP shortly after the ruling. This will give the exchange the financial firepower it needs to keep regulators at bay until reasonable regulations can be passed. On that note, another exchange that's been facing regulatory scrutiny lately is Binance. So far, the exchange has been targeted by both the US SEC and the CFTC, as well as regulators in other countries. There's also been speculation for months that the Department of Justice is lining up to take a swing as well, and this has created significant uncertainty. Like Binance's layoffs, however, this possibility has already been priced in for months. That's why it's strange that the recent report that Binance had laid off 1,000 employees seems to have shaken the markets so much. This could be because of the high-profile resignations in recent weeks. Even then, though, it's believed that these resignations occurred on good terms, and most of the positions have since been replaced by even more impressive hires. Never mind the fact that Binance has been making progress with regulators elsewhere, namely in Kazakhstan. From our perspective, the only genuinely concerning Binance-related news came from BNB last week. For those unfamiliar, BNB was originally created by Binance and was, or rather is, the exchange's native coin. Naturally, its ownership seems to be concentrated in-house, so to speak. The concerning news in question is an upgrade that BNB will be undergoing this Wednesday. As reported by Cointelegraph, the Zhangheng upgrade will make it possible for Binance's validators to bring the blockchain to a halt in case of an emergency, such as a massive hack or exploit. If this sounds familiar, that's because Ethereum developers tabled a similar proposal a few weeks ago. The differences are that ERC 7265 occurs at the smart contract level, not the blockchain level, and that this circuit breaker feature is voluntary. Developers aren't obligated to use it in their dApps. Like the Zhangheng upgrade, the ERC 7265 upgrade was tabled because of all the DeFi hacks and exploits that continue to plague the industry. And another thing that both upgrades have in common is that they could theoretically be invoked in cases where no hack or exploit occurred, namely to comply with regulations and the like. Obviously, that is concerning, and it's even more concerning in the case of Zhang Heng because the feature exists at the blockchain level. Many believe that Binance runs all the validators on BNB, but if you watched our video about it, you'll know that's not the case, at least according to public data. This begs the question of why BNB developers didn't simply opt to implement these controls at the smart contract level like Ethereum devs did. The answer is anyone's guess, and ours is that it could be because they're trying to address a pre-existing issue on the BNB chain. Some of you may recall that one of the entities which exploited BNB took out a massive loan against BNB using the Venus protocol. In June, there were concerns that the BNB the exploiter used as collateral would be liquidated, and that this would cause BNB's on-chain price to collapse. It seems the BNB chain team worked to unwind some of this position by paying back a portion of the exploiter's loan, but apparently most of the loan remains, along with the liquidation risk. Implementing a freezing feature at the blockchain level could be the only solution, given the circumstances. Anyway, speculation aside, the upgrades proposed by BNB and Ethereum developers set a chilling precedent for the entire crypto industry. We could soon see other Layer 1 blockchains implement similar upgrades, making it possible for regulators to ensure total compliance. Some would say that is not very crypto. This relates to another elephant in the room, and that's China. If you watched our video about China's new central banker, you'll know the country hasn't been doing too well lately. The economy is slowing, the yuan is collapsing, and the new central bank chief has a history of cracking down on crypto. You'll also know that the yuan's weak position is making it difficult for the People's Bank of China, or PBOC, to respond and fix its problems with stimulus. This is why it's interesting that Western media outlets keep calling on the PBOC to start printing. They probably know it'll further weaken the yuan. If you watch that video, you'll also know that further weakening of the yuan means more capital control, which could translate into crypto crackdowns, possibly even in Hong Kong. As it so happens, Hong Kong's so-called crypto grey zone is reportedly attracting lots of money from the mainland. And in the midst of all this mess, Circle CEO Jeremy Allaire came up with an admittedly rather self-serving solution that could help solve some of China's woes, and that's to issue a stablecoin in lieu of a CBDC. FYI, most stablecoins are backed by government debt. A yuan stablecoin could allow China to subsidize its debt. It would also allow Circle to make some more money, assuming it's selected as the issuer of said yuan stablecoin. This seems badly needed considering that Circle has started cutting its workforce, something that we predicted because of USDC's declining market cap. Yield on reserves is how Circle makes money. Unfortunately for Circle, China is going full steam ahead with its CBDC. Case in point, the PBOC is now testing offline payments in digital yuan using SIM cards. It's safe to assume that the PBOC is rushing to roll out the digital yuan under its new leadership. CBDCs make it easy to impose capital controls. Fortunately for China, it has so far managed to prevent an economic implosion by focusing its stimulus on specific sectors. One of the largest recipients of this targeted stimulus has been the housing sector, where prices are reportedly resuming their decline after months of trading sideways. At the same time, China's exports have fallen off a cliff, down more than 12% compared to the previous year. It's easy to forget that this is simultaneously a sign that Western economies aren't doing too well either. After all, most of the demand for Chinese-made goods comes from the US and the EU. Demand for goods in the US and EU has likewise fallen off a cliff due to a combination of factors, including a supply glut due to over-ordering, consumers spending more money on services than goods, and consumption being kept down by rising interest rates that in many places are showing no signs of coming down. In fact, investors are still pricing in a 25 basis point rate hike at the Fed's next meeting, despite the soft inflation reading we got last week. This means that the economy could continue to weaken, and that means it's only a matter of time before central banks around the world start stimulating. The only question is when, and you'll know the answer when crypto starts rallying. It's the most sensitive to changes in liquidity. The rally we've seen since the start of the year suggests that liquidity is already rising, but it looks like the real resurgence in liquidity is still to come. So, be prepared. Turning now to the charts, we can see that BTC has fallen below the Bollinger Band moving average on the daily chart and seems to be squeezing. This moving average has been a zone of support and resistance across all BTC's timeframes. A squeeze down means more pain, a squeeze up means more gain. This ties into the ETH BTC chart on the daily. As you can see, ETH has gotten above the Bollinger Band moving average and appears to be squeezing to the upside. This suggests that ETH could rally relative to BTC over the next week. This either means a rally for both or sideways for BTC in fiat terms. Anyway, last week's top performing cryptos were XRP, surprise, surprise, Compound, Stellar, 1inch, and Synthetics, a peculiar combination given the cause of the rally. The overrepresentation of DeFi tokens could be a consequence of an increased demand for leverage in the face of rising ETH prices, as I mentioned earlier. Anyhow, XRP rallied because of Ripple's partial win over the SEC, specifically the part about XRP not being a security and sales of XRP on exchanges and secondary markets not being securities offerings. This means that XRP holders are in the clear, and that's really all they need to know. XRP's massive rally makes more sense on the weekly. Its price had been squeezing since last summer and finally exploded to the upside in response to the ruling. The massive wick on the top of the weekly candle tells you that a lot of XRP holders took profit, but the squeeze could continue nonetheless. Next up, we have Compound's Comp token, which rallied for unknown reasons. Our best guess is that it has to do with the new Encumber feature that was announced by Compound Labs earlier this month. It allows users to retail custody of their crypto while allowing other wallets to transfer their tokens. Comp's price action is similar to XRP's in that it started to squeeze to the upside on the weekly. Also, like XRP, Comp faces significant resistance, in this case up to the $100 level. If it can get above that, then it could continue to squeeze higher, but history suggests that a rejection is more likely. When it comes to Stellar, its XLM coin rallied for the reason you'd expect, Ripple's partial win over the SEC. For those unfamiliar, that's because Stellar is technologically similar to XRP, though with a few key differences. Even so, it's similar enough to imply that XLM is safe from regulation. XLM's price action is almost identical to XRP's, but with a fraction of the intensity. That said, it is squeezing on the weekly. As such, it could rally along with its peers. Now, take a second to consider that all these squeezes among altcoins suggest we could see more action from them while BTC trades sideways. The caveat is that this rally may not apply to all altcoins. One example seems to be 1inch's 1inch token, which seems to have rallied in response to integrations with other DeFi protocols and its presence at the upcoming ETHCC conference in Paris. Say, that conference could explain the ETH strength. Now, in contrast to its peers, 1inch is looking weak on the weekly chart. It got rejected at the Bollinger Band moving average and seems to be squeezing down, not up. And finally, we have Synthetics, whose SNX token appears to have pumped in response to the reel of Infinex, a front end for the Synthetics DEX that's intended to compete with centralized exchanges. There seems to have been a general uptick in DEX trading as a result of all the SEX crackdowns as well. Funnily enough, SNX is perfectly in the middle of the Bollinger Band moving average on the weekly, again with a squeeze. The coming weeks will determine whether this squeeze goes up or down. If this small sample of altcoins is anything to go by, the bias seems to be to the upside. We could find out very soon. And do note that you can join the Coin Bureau Telegram group to find out why coins and tokens are pumping in real time. The link will be in the description. And that's all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too. Don't forget to check out our deals page where we have massive discounts and airdrop bonuses of up to $40,000 on some of the best exchanges, only for the viewers of this channel. You can find the link to that resource and many others in the description below. Thank you so much for watching, and I'll see you all in next week's episode.